Good day, fellow investors. On my research platform, Philip asked these questions: if I have any updates on the 2020 research that I made on the Austrian stock market. Agrana, Mayr Melnhof, Polytech, Semperit, Lenzing and voestalpine, as they all seem like cyclical opportunities of the decade right now, and that is totally correct. In this video we'll discuss 10 Austrian stocks that do offer 2x to 5x cyclical opportunities because it's simply decade lows. For example, Agrana, I'll make a special sugar video so it won't be included in this video, but you can see here multi-decade lows, high dividend yields across the cycle. Mayr Melnhof carton, European paper industry, 54% down in 2 years, and all those Austrian stocks that we're going to discuss here. So I'm sure you'll find something interesting for you to follow and work on it further. If you want to see my 2020 analysis, just type in Sven Carlin Austria into Google and you'll find the full article stock by stock. I redid that. This is on my research platform. I'll put it on public preview and the link will also be in the description below. You can go through my opinion on these stocks that I have looked and selected 10 for you to discuss here. For those who don't know me, my name is Sven Carlin. I have been investing since 2002. I have also an academic perspective on things, always based on risk and value investing. I did really well for myself in this investing environment for the past 20 years. And since 2018, I have been running my research platform, analyzing thousands and thousands of stocks. And I think that we do have maybe the largest value investing channel on YouTube. Let's immediately start with AMAG, Austria Metal, the aluminum player in Europe, Austria. And you can see the stock price is significantly down. However, aluminum prices are not down. Of course, they are down from the exuberant levels of 2022, early 22, but still much higher than the average of the 2010s. We'll also discuss European economics because that is all related to these cyclical stocks. They say there is continued market weakness, especially in Europe. They do have cash flows from operating activities. However, there are also investments, and when you sum things up, it doesn't look good, especially if the pessimistic economic sentiment in the Eurozone continues. If we look at this, you see a lot of red here for Europe and much greener in the rest of the world. But this might be just the start, and we are already seeing the weakness in the stock prices. The global trends for aluminum is all good, all growth, in line with global economic growth. However, European situation is much weaker, and everything is halving. Net profits have halved and might also continue to do so if the negative situation continues. If we look at cash flows, operating activities, a little bit of taxes, a little bit of interest, not much is left from investing in AMAG at this point in the cycle. But yes, it is now the downturn in the cycle, and if you buy it now and the cycle reverts for Europe, then you have a 2x or close to it. However, from a risk and reward perspective, and also looking what's going on in Europe, which we'll discuss in a second, the European economic situation, I would wait for a dividend cut, let's say now at mid-possible cycle downturn, which means there is much more room. A real recession, that would make this even cheaper, and then we're already looking at 4x's going upward. Because if we look at the economy in Europe, we see that now things still look okay, which means GDP growth 0.8%. Of course, the exuberant European Commission expectations are always very positive. 1%, 1.6%. It's not stellar, but it's also not bad. However, I'm telling you, this is for Europe very, very good, and we have not seen a real recession where I think it can be -2%, of course, money printing, inflation, etc. Because if I look at inflation, it is stabilizing, there is GDP growth, so everything looks okay. The deficits are still there as always, but unemployment is 6%, which I think is the natural level for Europe. When we get to 9%, that would be a real recession, that would be a real downturn. And then, of course, all the stocks would be even cheaper, especially from this aluminum perspective. Now, another company that has not yet been caught into the cycle, but I think it might, but it is a good company, Andritz, industrial production and everything. And you can see here, as long as the dividends are growing, the stock remains strong. The market will react only when things go south, and things do go south as it is cyclical, and again, I'm telling you, it can get a lot cheaper. So this is one to watch if it goes cheaper, but now it's still not reflected in the market. Let's continue with our list, and we have AT&S, the semiconductor business from Austria. And you can see here, it was down, then it boomed, and now we are back to where we were alongside the semiconductor cycle. And it was very funny. In 2020, I said, interesting 5G IoT connection stock, possible double. And what happened? It tripled from when we analyzed it in September, only to revert back to where it was. What is the business doing? Well, they are making these substrates on which the chips go. They have now revenue of 1.5 billion, they have a good EBITDA margin, and their target is for doubling that revenue in the next few years. They have invested into new manufacturing plants, and if they succeed with that, then also this might change significantly. Their technologies, I'm not a specialist on technology, but I think it should be used wherever it is applied. However, it looks more like a commodity business than other, with some specialties. Nevertheless, they have been investing a lot, so now it looks ugly with the net profit negative. However, we must take into account that this has been a year with two big investments, Loben and Kulim Malaysia, that they plan will strengthen their market position, will double their revenues, especially if the cycle reverts. And they have significant debt, but as I told you, there have been huge investments. So capital expenditure, 1.1 billion euros 2023, about 600 million in 2022, and we are at 800 for 2024. So they are still investing, and if their projections are right, if revenue goes 2x to 3 billion, that is a big 2x. And then if we look at their profitability on the low revenue, 136 million, 100 million, also here 2019, depending on how this semiconductor cycle goes, then they could make 300 million in profits in a good year, and 300 million in profits time a P ratio of 20, because then the market gets exuberant, that's 6 billion, that's 10x almost for the stock. Let's put it a little bit lower, 200 million in profits times 24 billion. This stock offers a 5x potential, so the risk and reward is already very positive, and the next semiconductor boom might happen again. So semiconductor stock cycle to follow, and I will now dig deeper into it, analyze carefully the risk and rewards for a covered stock on my research platform. So I'm just giving you here the idea, you can follow it yourself or with the other stocks, but this is already very interesting because it's not related to Europe, it's related to the global semiconductor cycle. A company that is related to Europe is Mayr Melnhof carton, so paper in Europe. It did really well in the 2010s, only to revert in the last 2 years. But this is how cyclical companies work. Paper, cardboard, everything is there. And what is going on lately? The sales are there, but the return on capital employed is low now, and everything looks much uglier. So as you can see here, they are focused on Europe. We have seen 1% economic growth in good times in Europe. So the outlook, the long-term outlook is not that good. And when you look at the company, this is the key. The headwinds, prolonged economic downturn where we have not yet seen a downturn. These are good times for Europe. Downturn would be -2% from what Europe is in a global competitive landscape. So that will be the real downturn. And there is already margin pressure due to overcapacity in the carton board industry. What does margin pressure mean? Much lower cash flows, and then everything reverts from their investment perspective and also the market's perspective. But you buy cyclicals when things look bad, and now things are slowing down. If there is a reversal in the economy, in demand, then everything will look much better because they are Europe's largest carton board producer. But the key here is capacity. And if there is overcapacity, you cannot sell your things with a good profit. And if the economic downturn worsens and the overcapacity is not going anywhere, this can look ugly. The key is then to follow and understand when the cycle reverts. And when the cycle reverts, then you can again play on the upside of the cycle and make your 2-3x, but that is the cyclical investment game there. And we can see here the downturn in net income from an average. Now we are lower. However, I am also looking at the dividends. Net income 150 million, common dividends 70 million. They might continue, but 70 million still on the current market cap of 1.4 billion, that's still a return of 5%. I don't see growth in Europe that much, so I have put it here alongside the Nestlé's, and we are still priced for mid-cycle on our value investment quadrant. And something very peculiar for these companies, family-owned companies, so look at the debt level. No debt practically. So really minimal. And then somebody says, oh, we have to make this more exciting. Let's rack up the debt. Let's make acquisitions. We are not happy with that conservative approach. And what happens is that you rack up the debt, and from stability you go to instability, because when you have debt, payments, etc., is something very risky, and you destroy what someone has been slowly and steadily compounding for decades just on not being happy with what there is. This is typical for many European families and companies. Some investment bankers lights them up, and you have that as a result. This is very peculiar for this stock. But the competitive advantage, there is none, it's just paper, and the secular trend is very important to figure this company and investment out. It has to look ugly for the upturn because Europe is the green here and is the only continent with declining population going forward. With declining population, the secular trend is declining. With overcapacity there, it gets tricky, but there will be ups. The European Union will do things, print money, and that will give you some kind of upturns. But long term, keep in mind the cycle and the structural trend. OMV, the European oil business, you can see here not the decade lows, but not at highs. The dividend yield is strong there, and if I look at current oil prices, the free cash flow is around 10%. They will likely pay it as a dividend, 10% dividend, And if oil prices remain at these levels, that will likely be there 8, 9, 10%. And then I'm thinking, well, oil business much cheaper than Exxon perhaps at 3%, that is priced exuberantly. I will look at oil when we get to below 50, 60 a barrel, then we'll make a complete sector analysis. But I'm waiting for those prices because that will give me the right risk and reward for investing long term. Palfinger, another good business. You can see here these industrials not going anywhere, and you can play these cycles. This is again a global company. Okay, Europe, dividend is there, nothing wrong with the company. They are number one in the world with the cranes. So this is a business, some private company will take it over if there is trouble. So really good business. They have their margins, but this is it. Dividend yield 5%. A few years ago, everyone was happy. 3% because of the good quality business. And you can learn about this business, see how it fits your portfolio. It should be a good addition. And then you can maybe do a 2x on the upside when the cycle reverts. And this is most likely to revert somewhere in time. Now, another oil business, 7% dividend, interest rates went up, so a 4% dividend is not good enough, 7% with a little bit of slowing down. The US rig count went down, globally is flat, but a little bit less business for this oil equipment drilling business. They are making their cash flows, the dividends will be volatile, but then again, I'm always looking for even lower. But if you want to start and then increase your position if there is a crash in oil, this might be interesting already, but the downturn can be a little bit wider. So always leave room for these things. Nothing wrong with the business, has been around for a long time, and you can play the oil cycle with this. Let's continue. Semperit, plastic cycles, again something very interesting. The dividend yield is there. They are doing these businesses with no competitive advantages, and they depend on economic demand. So challenging market environment, of course. They are trying to reduce costs, etc. But the free cash flow actually improved. Their guidance is there. 80 million EBITDA, private businesses, if they sell at 10 times EBITDA, that's 800 million. So that's 4x. And you can see here that in good times, the company reaches that levels. 2-3x cyclicals possible. The current cyclical downturn, that again, reiterating myself, might even get worse. Challenging market conditions to continue. EBITDA 80 million, capex 70 million. In reality, not much is left, but 10 million for dividend, that's already 4-5%. And then you can wait for the cycle to revert. If I look at their targets, if they reach this 120 million EBITDA, if they can push the dividend to 30-40 million, that's 10% even higher, then the stock will easily double. They estimate global growth at 2.6%, but again, the risk is always a deeper recession because we are not closer to a deeper recession. However, they have liabilities, other liabilities including deferred taxes, so there is some liability, but you can see here how they work, how their net income works across that cycle. And if you can get this upside when it comes, the 2x, 3x is there. So let me conclude by saying that these businesses are good businesses, have been around some for hundreds of years, and it's unlikely that these businesses will go anywhere. And the message is learn about the businesses. 2 to 3x, 5x potential lies in each of these stocks that we have discussed. Austria is not really the hot financial environment, and therefore you can find these cheap stocks when the cycle reverts, but you need to learn the cycle for each business. When the cycle reverts, there is an opportunity. I wanted to do this video to structure my thoughts and now see which ones of these will go to my covered stock list, where I dig deep to learn the cycle when I have something to follow that I think the market is misunderstanding. Because if you have 10 stocks at cyclical downturns, the market must be wrong on a few of them. And that is something that we have to catch. Find opportunities with low risk where the market is painting everything with the same brush. If you like this analysis, subscribe, check my research platform. I'll see you in the next video.